Hey everyone, Dave here. We are inside of a fictitious real estate portfolio consisting of 15 properties. This analysis is loosely based on one of these that I did recently for a client. And we're going to go through and just show how we look at a mature investment portfolio, what we look for, the things we calculate, and how we might go about making some decisions on what properties to keep, what properties to sell, what to do within the existing portfolio, other possible exit strategies. So lots wrapped in here. So let's get started. We're in the top section here. This client had great records for me to review. They had 4 years of records to go through, where we could look at gross rents and then what they took home from the property manager, their total management fees and repairs, and then we broke that out specifically into management fees and repairs. And so this investor in 2021 had a portfolio actually of 19 buildings and ended up having like a really lousy year in terms of repairs, almost $100,000 across the whole portfolio, about $5,000 a building. And so just decided, hey, I got to start skinning this thing down to get rid of some underperforming buildings. And so you can see over time, this investor, sold a building, sold another building. Oh, had a pretty good, great year of repairs, actually. Didn't sell any buildings, but then had a little bit of iffy rent collection and repairs started creeping back up. And so they actually sold 2 buildings last year to now get down to this property of 15 buildings that you see at the bottom. And so for this 4-year period, they're having the properties managed 10%. And then the repairs are averaging about $3,150 a building. This portfolio is now currently worth about $2.5 million. Average value of the building is about $156,000. Now, fortunately, this investor paid about $50,000 coming out of the housing crash for these buildings. So pretty much anything that happens from here is a win. These things have been cash flowing, but we're starting to kind of get some yield compression down here, which you're going to see. So, regardless again of what happens, this is a happy story, but we're just deciding what to do from this point. But newer buildings, we think maybe about 0.6% that we'd be expecting to see for repairs. So you'd figure about $930 a building. But again, these things are older, roofs are going, HVAC systems are going, had some bad tenant move outs in there. Anyway, these are clocking at about 2%. And this owner is getting tired of writing all these checks and figuring out what makes sense within the context of their portfolio. So we can then go down here and look at this portfolio on a property specific basis, these 15 buildings. Here's their respective values. Here's what this investor is paying for taxes and insurance. Monthly rents are here. We're going to come back to this rent factor at a later point in the discussion. So annualizing rent, taking out vacancy, that's the predicted rent. We've got some carryover here. Some of these cells, just want to make it look a little nicer. And so then management fees coming out. Now, again, we're just assuming an expected repairs percentage of 2.0% of the building value that we calculated up here. Actually, went in with this owner and looked at buildings that had been recently repaired and upgraded, took this factor down versus buildings we know need a new roof or HVAC or something else. Bump this up to get to some real numbers here. But that's what hops out with expected repairs. And then predicted cash flow is the projected rent, less taxes, less insurance, less this management fee and expected repairs. And that's what each of these buildings is cash flowing. And so then, and something that's conspicuously absent here, you didn't see a mortgage payment. And I see this with a lot of mature portfolios. These are older owners. They fully paid these things off, don't really want to take on additional debt at this stage. So we're not utilizing any leverage here. And that's why, one of the big reasons why these yields aren't great, because We're just looking at this predicted cash flow over the total value of the building. So we still have some nice properties here. A fully paid off building, consistent rents, yielding over 5% for somebody who's later in their investing career. That's not terrible. But we've also got, kind of some dogs down here. Once we start to drift below 3.5%, even some sub threes down here, that really starts to be concerning. And, we can make ourselves feel a little bit better. It's like, wow, we can't really get all this money out of the buildings because, we have to pay taxes on these things. So even with paying taxes and looking at the after-tax proceeds and net of closing costs, again, some of these yields up top are excellent on that basis, but, some of these below, we can get this money out of the building, and we're really only giving up 4%, and we can get that currently in U.S. Treasuries. If nothing can change here, these bottom two remain very attractive candidates for sale. So what do we look at when we're in a situation like this? Well, this column is key right here, and this is what I call rent factor, which is basically monthly rent divided by the value of the property. And amazingly, there used to be something called the 2% rule, where you could actually command 2% rent of the value of the building. That's a fantasy these days. Really, anything above a 0.8 is a pretty good building. So we feel great about rents here. Even the 0.7s, if these are good tenants, we might be fine in here. But one of the easiest things to do is bring rents back up to market rate. And so if we're really only charging 0.65% of rent as a fraction of the building's value, one of the easiest things to do is try to raise rents in this market, and that may correct some of these low yields. A second thing, again, is if you can't raise rents and maybe there's some repairs imminent in some of these buildings, sometimes it does just make sense to parcel off pieces of the portfolio, eat the taxes, and move on elsewhere with the money. A third option is doing a 1031 exchange. So if you can identify some decent deals somewhere else, either in this market or a different market, that can command a higher cash flow. It's certainly an option to do a 1031 exchange and move into some new buildings. A fourth option is, again, older owners sometimes are reluctant to do this, but not always. Let's take on some leverage here. Let's take out a mortgage. Yes, that's going to eat up some of the cash flow, but that's absolutely going to improve this yield when we're looking at the remaining cash flow, not over the total value of the building, but over the total value of embedded equity that you have in there. That's a different story and often a much better number. And finally, if we're really late stage here in the game and just getting tired of managing properties, we can 1031 into something called a Delaware Statutory Trust, move to more passive forms of a form of a real estate investment. And that's really key if we're late stage here, don't really want to do anything active, but want to preserve step up in basis for heirs. So that's it in terms of how we might look at a mature portfolio of real estate properties and some of the considerations to decide what to do when encountering returns that we don't love. That's it for now. Like and follow if you'd like to see more from me. Take care.